Hey guys, congratulate yourself because you are watching that video which will help you a lot in your development. So what exactly are we going to learn today? If you are ready, let's learn together. In the world of finance, investors and individual financial managers need solid strategies to succeed. However, factors such as emotional decisions, short-term thinking, and hasty actions often act as barriers to creating the right strategy. One of the most common mistakes is the desire for a quick wealth. People tend to make risky moves, hoping to predict market fluctuations correctly and achieve sudden large profits. Such high-risk approaches are usually unsustainable and can lead to sudden losses. To succeed in the financial world, it is essential to adopt a strategic, unemotional approach. Setting clear goals, properly assessing risks, and thinking long-term are the cornerstones of a sound financial strategy. If you understand the logic of a proper strategy and have let go of dreams of quick wealth, you may continue watching the video. The strategy I will explain in this video is a strategy used with liquidity and breakup structure. Our rules for this strategy are as follows. We should see a liquidity purchase at a top or bottom. After liquidity is purchased, we should see a breakup structure. After breakup structure, a supply or demand zone is defined and we wait for the price to mitigate it. For understandable, I will first explain with simple drawings and then in detailed way with graphics. First of all, the logic is very simple as seen on the screen. Let's repeat the rules with drawings. According to our first rule, we want to see a liquidity purchase. The section shown with red lines represents the liquidity purchase points. Yes. Since we see liquidity purchase, we are looking for our second rule, which is breakup structure. In the drawing, the section shown in the blue area shows us that the breakup structure has occurred. Now that these two rules are met, the last thing we will look for is we determine a supply or demand zone in the liquidity buying zone and wait for the price to come to this zone. Since we have defined a supply and demand zone, we expect the price to come here, and when the price comes to this zone, we can create a scenario like the one below as an example. Our stop point will be just below or above the supply or demand zone. Our TP zone will be the last point that the price reaches. Yes, it is that simple. Before we show it on the graph, you are learning the simple model of this strategy. This video will definitely be useful for you in terms of understanding the logic. If you want to adapt this strategy in a more suitable way for you, do lots of strategy tests, and of course, don't forget that the developed form of the strategy will be found on my channel. Don't forget to check out my channel for more developments and strategies and subscribe to be informed about the videos instantly. Your support is important to me. It's now. Here's the turn to see how this strategy looks on a graph. The first chart we'll examine is here. Everything will progress as we did in the beginning, and you'll see how simple this strategy is in actual application. When we look at the chart, the first thing we would look for would be a liquidity sweep, right? Yes, absolutely. When we look at this area, we see a great accumulation of liquidity. If the price wants to go higher, it will come for liquidity. And we're looking to see what? Yes, a liquidity purchase has taken place in this area. So what's next? Next is breakup structure. We look at our graph to see if there is a break. Yes, there is right here. And finally, what we will do is, since we are examining a bullish structure, we find the demand area. Yes, we can now determine the profit and stop points since we have marked this area. We can buy from our demand zone. Our stop point will be just below the demand zone. The last point reached by the price will be our profit take level. We can enter the trade according to these rules. And as you can see, we have a profit ratio of approximately 1 to 2.5 on this trade. Our next example comes from the Eurodollar. As always, the first thing we look for is a liquidity sweep. Can you find the liquidity area here? It's obvious right here. Next, we are looking for a break of structure, and it is right here. Now, there is something I want you to pay attention to here. The candle where the breakout occurred here is a voluminous sell candle. There is a large fair value gap area at this point. This increases the probability that the price will want to turn back. Since it is a voluminous candle here, we will not take the entire candle as the supply area. In such cases, the candle line can be taken as the supply. Now that we have determined our supply area, we can move on to the transaction setup. We enter from our supply area, and our stop-loss point is just above this area. The last place the price reaches will be our take-profit point. Yes, we have now learned a strategy that we can use in our transactions in its simple form. At the end of the day, you have learned a strategy that will help you get your own trades. It is in your hands to improve your strategy and use it in the best way for you. Remember, captains need a compass to avoid getting lost at sea, and without a compass, we can say they are going into nothing. This is the same situation for traders. Traders who do not work on a specific strategy and test more strategies than necessary are destined to be lost at the end of the day. That's it for today's video. I hope it was useful for you. Don't forget to subscribe to my channel and like the video for more content like this. Take care of yourself, and see you in the next video.